It's October 1929. You're in New York City. The air smells like coal, steel, and limitless optimism. The Dow Jones Industrial Average has climbed 300% in just 5 years. It's a rocket that only goes up. Stocks for the Radio Corporation of America, the tech darling of its day, have soared from $150 to $114 per share. Everyone you know is playing the market. Your shoeshine boy is giving you stock tips. Your tailor is telling you about a sure thing in steel. It's called the new era, a time when the old rules of value no longer apply. But this entire 50-story skyscraper of wealth built on a single cracked foundation. In 90 days, $30 billion of that wealth will evaporate. That's $490 billion in 2025 money. It's a collapse so total, it will drag the entire world into a decade of darkness. We look back and think, how could they be so blind? We think we're safer now. We think we learned our lesson. We built circuit breakers and safety nets. But the patterns from 1929 aren't just history. They are a 5-step blueprint for financial disaster. And our economy right now is following that blueprint step for step. To understand what's happening in 2025, we have to go back to 1929. The first step in the blueprint is mass speculation. In the 1920s, the public fell in love with the stock market, but they didn't have cash to buy stocks. So Wall Street offered them a magic key. It was called buying on margin. Here's how it worked. You wanted to buy $1,000 of that hot RCA stock. You only had to put down $100, just 10%. Your broker loaned you the other $900. This wasn't a niche tool for professionals. This was a mass market product. It was the buy now, pay later of its generation. Total brokers' loans, the money loaned to the public to buy stocks, exploded. They shot up from $3.5 billion in 1927 to over $8.5 billion by September 1929. This flood of borrowed money pumped the market to impossible heights. It created a feedback loop. Margin buying pushed prices up. Higher prices convinced more people to buy on margin. This loop pushed the Shiller P/E ratio, which measures stock prices against real company earnings, to a peak of 32.6. The historic average is around 16. Prices were 100% disconnected from the real economy. People weren't buying companies. They were buying ticker symbols. They were betting that the price tomorrow would be higher than the price today. This works until it doesn't. When prices stopped rising for even one day, the system reversed. The margin calls began. Your broker wants his $900 back, not next week. Now. To get the $900, you have to sell your stock. But so does everyone else. Sellers overwhelmed buyers, and the rocket that only went up suddenly went into reverse. Which brings us to today. We banned that kind of 10% margin. You need 50% down now. We're safe, right? But here's where it gets interesting. Human nature always finds a way. We just invented new, faster, and more dangerous tools. We don't call it margin. We call it commission-free trading. We call it meme stocks. We call it crypto leverage. And most importantly, we call it options. Specifically, 0-day to expiration options. These are lottery tickets on the market. They are hyper-leveraged bets on where the S&P 500 will be in hours, or even minutes. In 1929, you could get 10-to-1 leverage. With 0 DTEs, traders can get leverage of 100-to-1, 200-to-1, or more. The volume of these contracts has exploded. In 2017, they were a rounding error. Today, they account for over 50% of all S&P 500 options volume on some days. The nominal value of these bets is staggering. It regularly exceeds $1 trillion. This is the 1929 margin loan, repackaged as a sophisticated product. It's a $1 trillion casino running 24/7, and it's sitting underneath the entire U.S. financial system. It's the same speculation, just digitized. Step 1 complete. The second step in the 1929 blueprint is extreme wealth inequality. The roaring 20s were roaring, but only for a few. In 1929, the top 1% of Americans held 40% of the nation's wealth. The top 0.1%, just a few thousand families, held 25% of the wealth. This wasn't a healthy, broad-based boom. It was a narrow, top-heavy concentration. You've seen a champagne tower at a wedding? Where the champagne fills the top glass, then overflows to the glasses below. The 1920s economy was a champagne tower, where 90% of the champagne stayed in the top glass. While Wall Street partied, the real economy was flashing red. Farmer debt was catastrophic. A Fordney-McCumber tariff had crushed their ability to sell grain overseas. The construction boom in cities like New York and Chicago had peaked in 1926. And here's the key fact. U.S. industrial production, the real economy, actually peaked and began to fall in August 1929. That's 2 months before the crash. The economy was already sick. The stock market was just the last to know. This massive wealth gap meant the entire system was fragile. It depended on the spending and investing of a tiny, tiny fraction of the population. When that top 1% got scared and stopped spending, the whole thing collapsed. So what does that 1929 picture look like today? It looks terrifyingly familiar. As of 2025, the top 1% of Americans hold 31% of all U.S. wealth. The top 10% hold 68% of the wealth. Meanwhile, the bottom 50% of the country, 165 million people, hold just 2.5%. We have the 1929 wealth distribution all over again. And just like 1929, we see a massive disconnect. The stock market, fueled by an AI frenzy, hits new all-time highs. A handful of tech stocks, just 7 companies, are responsible for almost 90% of the S&P 500's gains. Nvidia's market cap soars past $3 trillion. The party at the top is deafening. But for the bottom 50%, the real economy feels very different. U.S. credit card debt just crossed $1.1 trillion for the first time in history. The average interest rate on that debt is 21.47%. Auto loan delinquencies, people failing to pay their car notes, are at their highest rate since 2010. The market is telling one story. The household budgets of 150 million Americans are telling another. This is the same crack that appeared in August 1929. The market is roaring, but the foundation is cracking. Step 2. Complete. The third step in the blueprint is psychological. It's the 4 most dangerous words in finance. This time is different. In 1929, this was called the New Era fallacy. The famous economist Irving Fisher made a declaration. He said, "Stock prices have reached what looks like a permanently high plateau." He said this just days before the crash. He wasn't stupid. He was blinded. He believed the new technologies of his day, radio, automobiles, electrification, had fundamentally changed the rules. He argued they created so much new efficiency that old metrics of value no longer applied. He believed the economy could no longer have a bust. He was catastrophically wrong. Now, listen to the language of today. What is the justification for the market's incredible climb? Artificial intelligence. We're told AI is not just a technology, it's a paradigm shift. A word I'm not supposed to use, but they do. It's a fundamental revolution in human productivity. We're told it will create trillions, tens of trillions in new value. Old metrics like price-to-earnings ratios are dismissed. If you question why a company with no profit is worth $50 billion, you're told, you just don't get it. You're missing the AI story. This isn't investing. It's the new era trap. It's the same belief that infected Irving Fisher. The belief that this time the rules of gravity don't apply. They always apply. Step 3. Complete. Step 4 is the collapse of confidence. And then, everything changed. The market didn't collapse in one day. It was a 4-day execution. It started on Thursday, October 24th. Black Thursday. The market opened with immediate heavy selling. The new high-tech ticker tapes couldn't keep up. They ran hours behind, creating total blind panic. No one knew the real price of anything. A group of top bankers led by J.P. Morgan's successor met at 23 Wall Street. They did what they always did. They pooled their money, $250 million, to buy stocks and restore confidence. They made a show of buying U.S. steel. It worked. For one day. The market stabilized on Friday. But over the weekend, the public had time to think. They saw the bankers move not as a sign of strength but of desperation. They sent sell orders to their brokers for Monday. On Monday, October 28th, the bankers stayed silent. The market fell 13.5%. Then came Black Tuesday, October 29, 1929. The margin calls hit all at once, a tidal wave of selling. 16.4 million shares were traded, a record that stood for 39 years. The Dow fell another 11.7%. The bankers who had been heroes on Thursday were powerless. The market had become a runaway train. It didn't stop falling until July 1932. By then, the Dow had lost 89.2% of its value. A $10,000 investment in the new era was worth $1,080. The dream was dead. Step 5. The contagion. This is what turns a stock market crash into a Great Depression. In 1929, the crash became the Great Depression because of the banks. The market crash wiped out investors. Those investors couldn't pay their loans. The banks that made the loans failed. When the banks failed, ordinary people who never owned a stock lost their life savings. This triggered the bank runs. Over 9,000 banks in the United States failed in the 1930s. With no money, people stopped buying. With no buyers, companies stopped producing. With no production, companies fired their workers. Unemployment rocketed from 3% in 1929 to 24.9% by 1933. 1 in 4 working Americans was jobless. That is contagion. Now you're thinking, this can't happen today. We have the FDIC to insure our deposits. We have bank regulations. We have circuit breakers that halt trading. You are right. We are not at risk of the same 1929 contagion. We have new ones. We solved the 1929 problem. But we created the 2025 problem. The contagion today won't be thousands of small banks failing over 3 years. The contagion today will be the speed and interconnectedness of the entire system. In 1929, the ticker tape was hours late. In 2025, algorithms trade in microseconds. A flash crash can wipe out 1,000 points, or 3% of the market, in minutes, as we saw in 2010. The zero DTE options we talked about? Many experts, including from JP Morgan, fear they could trigger a volatility event so fast that no human can stop it. A Volmageddon 2.0. And what about the bank runs? We saw a preview in March 2023. Silicon Valley Bank didn't fail over weeks. It failed in 48 hours. It wasn't a line of people on the street. It was a digital bank run, coordinated on smartphones. $42 billion was pulled out in 10 hours. Our system is no longer protected by physical distance and slow information. It is now exposed to digital speed and instant panic. The 1929 crash was a stampede of people. A 2025 crash would be a stampede of algorithms, and it would happen before anyone could even call a meeting at 23 Wall Street. So let's review the blueprint. Pattern 1. A new era technology story creating a bubble. In 1929, it was radio. In 2025, it's AI. Check. Pattern 2. Mass speculation using extreme, easily accessible leverage. In 1929, it was 10% margin. In 2025, it's zero DTE options and crypto. Pattern 3. Extreme wealth concentration and inequality. In 1929, the top 1% held 40%. In 2025, the top 10% hold 68%. Pattern 4. A disconnect between a soaring market and a weakening real economy. In 1929, falling production. In 2025, $1.1 trillion in credit card debt. Pattern 5. A fragile, interconnected system vulnerable to a crisis of confidence. In 1929, uninsured banks. In 2025, algorithm-driven digital speed fragility. History doesn't repeat, but it rhymes. Right now, the rhyme is deafening. We have the same speculative fever. We have the same justification that this time is different. We have the same systemic fragility, just hidden in new complex products. The only thing missing is the trigger, the one event that makes everyone run for the exits at the same time. Which brings us back to the core question. Are we at the peak of the party in October 1929? Or is the AI revolution so powerful, so real, that it can override a 100-year-old pattern? There are 2 paths from here. 1. The bubble pops. The zero DTE leverage unwinds, AI hype cools, and the debt in the real economy pulls us into a crash. It's 1929 all over again. 2. The AI productivity boom is real. It creates trillions in new wealth, boosts wages, and gracefully deflates the bubble without a pop. The new era is finally real. Which one do you believe?